mutual fund investments. Before we get into the intricacies and technicalities of how mutual funds do function, one of the important things which you need to figure out at this stage is how you're going to get impacted by the inflation and what is the impact of inflation on your purchasing power. What is the impact of inflation on investments? And I think I've already made this point in earlier sessions also when we were discussing financial markets in the very beginning, that investment is one of the important component of personal financial planning. It is extremely important for an individual to plan for his finances, and therefore he need to begin by reflecting upon his present financial situation, just the way we have diagnostic tests for or preventive health checkups to ensure that our body is fit and fine. Similarly, you need to do a financial health checkup, and financial health checkup focuses on your financial wellness, because when we reflect upon our life cycle, at different stages of our life, we need money for various purposes, right? The moment you're born, right, till a person dies, money is required. And one is required for birth, the kind of expensive healthcare system we have in India. So definitely a lot of money is spent there itself. Then money is also required for the upbringing of the child. Money is required for the education of the children, right? Once children grow up, you need to spend a lot of money on their upbringing, on their higher education, again on their marriage. Then you also need some of your personal objectives or financial objectives like buying a house, buying a car, uh, probably planning for your retirement. So all these things are essential part of your financial well-being, and these things have to be started as early as possible. It's not like that at the on the verge of your retirement you think that, okay, what should I do about my retirement and how do I go about planning my retirement. But all these things need to be given a thought at a very early stage. So when we say very early stage, what do you mean by very early stage? When we say very early stage, it basically means the moment you start earning, the moment you become independent. Because generally a student up to he completes your when a student completes his degree or post graduation, up to then he is invariably dependent on his parents. But when you have your own purchasing power, when you start earning, this is when a thought of financial planning and financial well-being should be brought into your mind to ensure that you don't have to struggle throughout your life. uh, Therefore it is very important to plan as soon as possible. So why it is important for you to plan, and how does mutual fund come into picture? So that is what we would be discussing in today's session. So first, let's talk about some of the important financial tools and equations what we use in personal financial planning. One of the important tool what we use in financial planning is the future value of money. So what you see, the formula, what you see here, this is the future value of money formula. So this formula will help us to identify what is the impact of inflation on the expenses. So how do you define inflation? So inflation is a tendency or a phenomenon in which the value of money will decline and the prices of goods and services will increase, which means that for a given unit of money, you will not be able to buy things. So you might have to restrict your ability. It will restrict your ability to buy things. So that is what inflation does. It will hamper your purchasing power. So this formula is a ideal formula for us to do an estimation. So here what I've done here is to explain you people how would inflation impact your expenses. I have taken 3 years duration. So what it means is at the moment, in case if you require 30,000 to run your family, to manage your household expenses, because most of you, even though you might not be directly involved, because most of you or some of you would rather say are not staying with your parents, but most of them, I'm sure you are staying with your parents. And in case if you are already married and you have your own independent family, then probably you can reflect upon your monthly budget. But because budgeting is one of the crucial part of financial planning, you need to have your budget to figure out what is your expenses and what are your source of incomes and whether you're able to save any money or not. So that's the first step towards financial planning, is to manage your income and expenses. So this formula, what you see on the screen, is basically giving us an idea that in case at the moment, if you have your monthly budget as 30,000, so that's the budget what you have. So let's say that is the amount of money what you require to smoothly run your household expenses, your personal expenses. So if it is 2000, if it is 30,000 in 2022, to maintain the same household, to take care of the same routine expenses, regular expenses, how much money do you require after 3 years? So after 3 years, to manage the same household unit, you might require 40,000 rupees, assuming the rate of inflation to be 10%. So this is something which you always have to bear in mind, because generally there is a tendency that people neglect the inflation factor. But whenever you're doing financial planning, you should bear in mind that inflation is one of the crucial factor and it can play a spoil sport in all your financial activities. So incorporate inflation factor when you're doing your budgeting. So in case if I'm planning, let's say I'm planning that what would be my household expense for next 3 years. So I can't be under the assumption and take only 30,000 as a flat amount for next 3 years. So I need to incorporate inflation factor in it. So on the one hand, you see inflation is trying to reduce your purchasing. Inflation is trying to make things more expensive. The other side of inflation is also horrible, because the other side of the inflation is that it reduces your purchasing power. So let's say if you have 1 lakh rupees saving at the moment in the year 2022, you have 1 lakh rupees savings. So that 1 lakh rupees of savings, what you have, that gets eroded over a period of time. So this is the present value formula. Present value of formula is primarily used to figure out the worth of money, incorporating the inflation factor. So in case if you have 1 lakh rupees now at the moment with you, the value of this 1 lakh rupees in 2022 is equivalent to 1 lakh rupees. But the same value of 1 lakh rupees after 5 years, and represents here the duration. So after 5 years, the 1 lakh rupee what you have, it is worth only 55,000 rupees approximately. So approximately it is just 54 or 55,000 rupees. So you need to do a balancing act here by ensuring that you don't get succumbed to the inflation factor. On the one hand, inflation is reducing your value of money. On the other hand, it is making things expensive and thereby reducing the overall purchasing power. So this is a picture which you need to paint your mind. You need to keep your mind. So let's do a head-to-head comparison now, in case if you feel that okay, 10% is a very high rate of inflation, it's not practical. In fact, many countries in the world have actually touched double-digit inflation. We also have once upon a time hit double-digit inflation. But if you want to be, if you don't want to be too pessimistic, and if you want to be a little optimistic about the rate of inflation, let's keep the rate of inflation of at 5% and see what will happen to your expenses and what will happen to the value of money. So let's see what's the impact of inflation, or if you want to call it as terror of inflation, you can also do so. So impact of inflation on monthly expenses, right? So your monthly expense, assuming it is 30,000 at the moment at present. So in next 20 years, what will happen? How much money do you require to manage the same household? So that's what we are trying to figure out by using the future value of money formula. So if you need 30,000 today, we are using the first formula, what I showed you here, future value of money formula. So this is the future value of money formula that will help us to assess the impact of inflation on our expenses. So let's look at the values here. So that's the kind of money what you require to manage your household budget. Assuming the inflation is growing at the rate of a moderate rate of 5%. So after 5 years, you might require somewhere around 38,000. So you see here we have kept the inflation rate little less and worked out. On the other hand, what will happen to the value of money? So all that money what you have, it will get eroded. So that's an important lesson you need to learn, that mere savings would not help you, right? Because a lot of time we do lay emphasis on savings. We always say that you need to save money, but for some that in itself is a challenge, because some people have so much of unnecessary expenses in their budget, unplanned expenses in the budget, that it is very difficult for them to save. And all these credit card companies are also uh, driving you to, right, spend a lot of money. On the moment you start earning, after 3 months one credit card company will approach you, you will buy that credit card. That credit card will entirely spoil your spending habits. You keep spending without any kind of accountability. At one point in time your spending is more than what you're earning. So that should not happen. Whether you have a card or not, you need to be very watchful and mindful about your expenses. Unplanned expenses is something which needs to be avoided, because planned expenses are fine, because you know that what is the amount of groceries you consume per month, what is the amount of money you need to pay towards your utility services, be it broadband, water, electricity, right? So those are recurring expenses, but these unplanned expenses are quite dangerous. So that is something that needs to be monitored. Now, coming to the value of money, the value of money declines over a period of time on account of inflation. So if you have 1 lakh rupees, in that 1 lakh rupees, what are the things that you can buy at the moment? But with the same 1 lakh rupees, what are the things which you can buy after 5 years? So probably in 1 lakh rupees, you can buy a good motorcycle now. But after 20 years, after 15 years, in 1 lakh rupees, probably you might not be able to buy the same motorcycle. On account of increase in the value of inflation, the value of money tend to declines. So therefore, if you are having a habit of merely saving money, it won't help. And all those people who always favor fixed deposits, that is also not helpful, because one of the important thumb rule of investment is something which I've already told you in the initial classes, that the rate of return what you are earning from your investment, that rate of return should exceed the rate of inflation. That is one of the important principles of financial planning. So when you deposit in fixed deposit, when you invest your money in FDs, fixed deposits or public provident fund and other means of investments, you hardly get somewhere around, let's say 6 to 7%. But that is also the rate of inflation. The rate of inflation is practically between 6 to 8%, which means technically you're not earning any of these things. You're not earning any money on your fixed invest securities like fixed deposits, certain types of bonds which gives a yield which is very less, public provident funds. So therefore you have to always invest in an avenue which offers you a rate of return which is more than the rate of inflation. Only then you will effectively end up earning something on your investment. So if you have 1 lakh rupees now as savings in your locker, the value of that 1 lakh rupees will decline over the period of time. So let's say you keep this 1 lakh rupees in a bank fixed deposit, and even if you earn some interest on that, even that interest will amount of interest will also lose its value on account of inflation. So somehow you need to figure out a way to beat inflation, because if you don't figure out the way to beat inflation, definitely you will have tough time in managing your budget, in fulfilling your lifetime goals. So you need to work out on a strategy. So what can be that strategy? Something we need to reflect upon now. Some of the strategies which are available to beat inflation, to manage the mounting cost of inflation or standard of living. So what are the options which are available? Let's explore these options. So first option is that obviously which I had figured out, that you need to save money to meet your expenses in the future. But are savings enough? The answer is no. Mere savings would not help you because whatever money you have saved, the value of that money will get eroded on account of inflation, something which we saw in those numerical calculations. So therefore, mere savings is of no use. Your money becomes worthless. So in order to ensure that you have sufficient financial resources to meet your financial goals like buying a house, taking care of your children education, their higher education, their marriage, your retirement, all this, how will you manage? One of the option is that you need to be from a very wealthy background. That means you should have some sort of a wealth which you would have inherited from your ancestors. So a lot of people who fall in this category, that they have very good wealthy background for them, uh, it's not a concern. So that's one of the option. Another option is to opt for a lucrative job. So if you are getting a handsome salary, let's say somewhere around 1 lakh rupees per month, then of course you can manage and take care of your expenses even on account of inflation. Also somehow you can manage. So that is another option, right? But unfortunately, not many people do end up in a lucrative job. By and large, most of the people who are employed, especially in urban cities, they get a very moderate basic salary. So what are the other options? Borrow loans doesn't seems to be a viable option to manage inflation. Borrowing a loan doesn't sounds good, but there are people who do so. Right, at one point in time, their income or incomes from various sources is not sufficient to meet their expenses. So as a result of this, at times, most of the people in India, most of the lower middle class and middle class families do end up buying loans, do end up taking loans because at times, all of a sudden, if there is any medical emergency, that's the story in India, and then something which we were discussing in the previous chapter also. If there's any medical emergency, unfortunately, most of the people don't have loans. I mean, don't have insurance. So invariably, they either sell their assets like jewelry and take loan, or sometimes in case if they don't have any asset, they have to take loans, and that loans will be paid over a period of time. So borrowing funds again for children education, a lot of parents money won't be sufficient to manage routine expenses. So how will they meet educational expenses, because education is such an expensive affair in India now, right? So therefore again they end up borrowing loan because they don't have sufficient money saved. So all these challenges are also there. What can be done about this? What are the other options available? The best option to manage inflation, to beat inflation, and to ensure that you have sufficient wealth, sufficient money accumulated to meet your life goals, right? Life goal, as I mentioned, can be education of your children, all that. All these are called life goals. You have to focus on financial planning. So in financial planning, what is that we do is simple. It's financial planning is not a rocket science. As I said, financial planning is all about budgeting. So first you need to do an appraisal of your budget, which means you have to figure out what are your sources of incomes and where that money is getting spent on. So once you are able to do an analysis, you are in a better position, right? And mere doing this analysis won't help you. You need to have the urge to meet those financial goals. So therefore, in case if you figure out that in your budget, your expenses are on the higher side, especially unplanned expenses, then you have to put a full stop on them. Somehow you should manage your budget in such a way that the income is more than the expenses, because that should result in savings. And these savings, mere having savings or keeping the money idle will definitely not help you because your money value will come down. Therefore, this savings needs to be channelized in an avenue which will give you decent returns which are more than way more than the rate of inflation. So investment is one of the things which you need to focus on at this age, not at a very later stage of your life. At a very early stage of your life, you need to have an appetite to save money, to invest that money, and to make money out of that money what you have invested. And this is the best age to take the risk, because once you have all those responsibilities on your shoulders, you might not be able to take the risk. But at a younger age, you can take the risk because you don't have much responsibilities on your shoulders. So therefore, you can take the risk. You can invest your money in risky avenues like stock markets and make money. So investment is a must, and investment should begin at a very early age. Whether it is insurance or investment, you should do it as early as. So the question is, where should you invest now? As you can see at the bottom of the slide, you have such a wide spectrum of options available. You can you can do your investment in shares, in debentures, in bonds, in money market instruments. Money market is a market for short-term investments. So short-term investment is less than 1 year. So in case if you want to invest for a short term, that option is also available. Then you have bank schemes like fixed deposit, recurring deposit, time deposits, all that. Real estate. Real estate is not that easy to invest. In order to invest in real estate, you need to have a big budget. You need to have a lot of money at your disposal. Then you have bullion. Bullion is your precious metals, gold. And obviously, there are so many other new options which have also emerged of late. You also have the option of investing in digital currency like cryptocurrency, which is very high risk class asset. So therefore, all these options are available at your disposal. So you need to figure out which one suits your palate, which one is more aligned with your risk taking ability, because choice of investment is determined by various factors. It is determined by the age first, and most of you are quite young, so definitely securities market is one of the best options for you. Second is your risk taking ability. Some of you don't mind taking risk, but some of you fear, and at any cost you don't want to lose out the capital what you want to invest. So for such people, definitely stock market is not the right avenue of investment. You need to think of alternative avenues of investments like debenture, bonds, bank schemes, because they are relatively less or no risk involved in such investment avenues. So your risk appetite is also very important. Risk appetite is nothing but your risk taking. Now, when we look at the rates which are offered by various investment avenues, as you can see here, most of the investment avenues do not offer that great rate of interest, right? Savings bank accounts hardly yield 3 to 5%. So savings bank account is a useless avenue of investment, right? Then you have bank fixed deposits, which hardly offer us 6 to 6.5 or 6.75%. At the max for senior citizens, 7%. Nothing beyond that. Then we have bonds also, who don't offer anything beyond 8%. Similarly, a fixed deposit. So therefore, you need to scrutinize these factors, the factors which are listed on the left side of this slide. What is the rates of return? Whether the return is taxed or not, because at times most of the people overlook the tax factor. And even though the rate of return is good on a certain avenue of investment, but that return gets eroded, washed off in higher tax rates. Now, as you are aware that recently the finance minister has also decided to levy 30% tax on cryptocurrency or the digital currency transactions. So 30% is quite a huge amount of rate of tax. So consider rate of tax also. And when we say fixed deposit, is fixed deposit interest earned taxable? The answer is yes. Is interest earned on company deposits taxable? Yes. Are interest earned on RBI bonds, government bonds taxable? The answer is there are few bonds which get exemption, but by and large, even they are taxable. So you need to consider the tax factor also. So if you say that you are not a risk taker, you don't want to take risk and lose your money by investing in stock market or any other investment avenue which is quite risky, then let's say I would recommend you to invest your money in fixed deposit. But the problem is whatever returns you earn from fixed deposit, they are taxed at the rate of 10%. So if you have earned 10,000 rupees by investing 10 lakhs at 10%, on 10,000 you have to end up paying 10%. tax. So there is a tax on interest earned from fixed deposit. So in these safe avenues of investments, which are bank deposits, corporate deposits, RBI bonds, corporate bonds, debentures, which is the avenue which offers you complete tax benefit? The avenue that offers you complete tax benefit is actually not listed here. It is Public Provident Fund and National Savings Certificate. So Public Provident Fund and National Savings Certificate, they are similar to your fixed deposit, but the only difference is that the return is slightly on the higher side. And most important benefit is that the return generated from National Savings Certificate or your other schemes like Public Provident Fund, they're not subject to tax, which means whatever returns you earn, they're not taxable, they're tax free. So sometimes tax factor is also one of the important consideration that needs to be kept. So first figure out the rate of return. Once you have figured out the rate of return, then assess the impact of tax, figure out the tax liability. And the third most important thing which you need to do is that you need to figure out whether the investment avenue what you have chosen, whether it has impact of inflation or not, whether it can protect you against inflation or not. So all these investment avenues, what you see on your slide, these avenues are useless because they don't protect you against inflation. The rate of return is also very low compared to other forms of investments like equity and real estate. So therefore, in case if you have already invested your money in these investments, consider reallocating that funds because this is of absolutely no use at all. Which are the other options which are available, right? When you look at this uh, graph, it gives you an idea. It gives you an idea as to what can happen. Even though some of the government securities and bank fixed deposit, their rate of return definitely is not 10%. Somewhere between 7 to 8% is maximum what you can earn. But this is the kind of returns what various terms of various forms of investments have generated in the past over the period of time. And when you compare here all these investments, equities, that is your share market stands apart. So share market has the capability of beating the inflation. So therefore you need to choose an investment avenue which is capable of generating a return which is much higher than the rate of inflation. So, so it's no doubt that equities are very good in terms of hedging against inflation risk. But the problem is it is quite risky and understanding market requires you to dedicate time. I'm not saying that you need to have a super advanced qualification to do trading in stock market. Anybody can trade, but learning that wisdom, learning the art. What is the art? What is the art of investing in stock market? Stock market investment requires certain skills. Skill number one, you need to learn the skill of or the art of picking stocks. It is like choosing your life partner. You end up doing wrong selection, gone. Your entire life becomes miserable, right? So therefore, it's similar to that because when you choose a stock, you need to have a proper analysis behind its selection. So that's the first skill you need to learn if you want to invest in stock market, the skill of picking the stocks. Apart from that, you should also learn the art of timing. You should learn when to enter the market and when to exit the market. And this is where most of the people end up doing mistake because most of the time people enter the market at the wrong timing. When the market is on its peak, people buy shares because in India we follow herd mentality, especially individual investors, they follow herd mentality. So if one is buying a particular share, everybody will start buying. There is no proper analysis behind stock selection. So it's a herd mentality. So people go by the momentum. If everybody are buying, okay, let me also buy. The problem is you will end up buying a share at a price which is on a very higher side. The valuation will be on a higher side. So therefore, timing is important. You should know when to buy, or in other words, when to enter or when to exit. Or you can also say when to buy and when to sell. So first skill is stock picking. The second skill is timing. If you earn these two skills, then it becomes much more easier in stocks, much more easier to earn better returns. You can maximize your returns by mastering these two important skills. These two skills are very important. But who has the time and energy to master these skills? Some people don't have time. Some people don't understand. So what is the alternative? What is the alternative for all those people who don't have the time to master this skill? What I just mentioned. How about these people? Because one of the interesting quote, there are many quotes given by Warren Buffett, who is considered to be the guru of stock market investment. So Warren Buffett, in one of the quotes, says that be greedy when others are fearful, and be fearful when others are greedy. That's one of his mantra, and this mantra is aligned with the market timing, which I mentioned that one of the important skills is that you need to learn the art of when to enter and when to exit. So the art, what is the solution for this? When to enter, when to exit? We can follow the guidance of Warren Buffett. So he says, be greedy when others are fearful. So what it means is Warren Buffett is saying the best time to enter the stock market, the best time to buy shares when the market is crashing or when the market has crashed, when the market is bearish, when there's a downtrend, when the stock prices are falling, that is the best time to enter the market, because the quote says, be greedy when others are fearful. And when to sell, when to buy, he has given you an advice. When to sell, the quote says, be greedy when others are fearful and be fearful when others are greedy, which means when the market is undergoing a bull run, when the market is on its peak, at that time you should sell. But things happens is quite opposite with individual investors. With retail investors like you people, individuals, we have a tendency that we end up doing opposite to what Warren Buffett says, which means we end up buying at a situation when the markets are at all-time high, when it is extremely bullish, and we end up selling when the market is extremely bearish, which means you end up losing all that money what you have invested in the stock market. So timing is important. So therefore, an alternative solution to those people who find it difficult to master the art of stock selection and stock market timing, for them the better alternative, indirect way of investing in stock market. So direct way is quite dangerous, as I mentioned, because you need to learn the art of stock selection and learn the art of stock market timing. So this is very risky. It takes a lot of time and expertise, right? And you might require capital, and you might be prepared to lose your capital also because of your wrong selection. So the best way to do it is through mutual funds. Mutual funds is an indirect way of investing in stock market, and mutual fund is very simplified way, an efficient way to do it. In mutual fund, you don't invest money in stock market, but you give your money to the mutual fund company, and they do the investment on your behalf. And whatever return the fund generates, it is distributed to the mutual fund holders, just the way we have shareholders. So all that money which is getting generated from the investment gets distributed between mutual fund uh, holders. So that's the indirect way of investing in the stock market. The good thing about here is that you can invest in small amounts also. You can invest as low as 100 rupees a month, right? Which is quite convenient. So systematic investment plan, also known as SIP, can be followed, investing regularly, even if the amount is very less. Second, expert is on your side. you're not investing in stock market, in mutual funds. In mutual funds, you're giving your money to mutual fund company. Mutual fund company is responsible of taking care of your investment. So they will invest on your behalf using on your behalf, and whatever interest or whatever returns gets generated, they will distribute to you. So expert is on your side. Experts do all the planning. Experts have, in fact, these experts performance is linked with the performance of the mutual fund. If the mutual fund is doing well, they also get better incentives. So expert is on your side. That's one of the advantage. So what exactly is a mutual fund? Let's look at the definition. So mutual fund is a trust that pools the savings of a number of investors who share a common goal. So mutual fund is a trust, which means that mutual fund is registered as a trust and it is under the custody of a trust. So therefore, there is an organization called trust which foresees the management and governance of mutual fund. And it also says that the money gets pulled up from various investors who are interested to invest, obviously, and that money gets channelized in financial avenues that have common financial goals. So let's say you people are there in the class. How many are there? Five or seven. So you seven people, your all goals of investment might be not be same. Let's say there is first three of you who want complete safety of money. So that's your goal. You don't want to lose your money. But there are another three people in your class who are willing to take risk for higher return. So here I cannot create a common mutual fund for all of you because there is goal incompatibility. Some of you want safety, some of you want high returns. Some of you are risk averse, some of you are risk taker. So what happens? I cannot create a mutual fund for all of you. So therefore, we need to figure out what is the common objective. If people, there are people who want to take risk and who want to invest in stock market. So for such people, we will make an equity fund which exclusively invest in stock markets. And all those people who say that they're very conservative about not losing their money and they don't want to lose their money at any cost from their investment. For those kind of people, for those people who have such a common goal, so their money gets invested in some other investment of avenues which are relatively safe. So this is how it works. So let us represent the definition in the form of a diagram that will give you a better understanding, a better perspective. So this is how it is. So as you can see in the diagram, investors with common goal. So mutual fund company will create the investment scheme, and these investors, according to their investment goal, they invest in the scheme offered by mutual fund company. So mutual fund company collects that money, and that money is handed over to an individual who's called a fund manager. Now, fund manager uses his expertise, his experience, and these fund managers, depending on the objective of the mutual fund, they channelize the money in financial markets. So financial market is a broader term, something which we discussed in the first chapter. So financial market has bond market, gold market, stock market, real estate market, forex market. So depending on the objective of the mutual fund, fund manager will invest the money in financial market, and whatever returns is generated, that gets distributed amongst the mutual fund holders. Obviously, fund manager and the mutual fund company is not doing it in charity. So you may have to pay them as their fees. So fund managers, mutual fund company deducts a small commission from the returns generated that is distributed, and that is considered to be the profit of the mutual fund company. So this is how mutual fund works. So anybody with an investable surplus of as little as few thousand rupees can invest in mutual funds. Forget about few thousand rupees. Even if you have some 100 rupees saved on a monthly basis, you can channelize your money into the mutual fund. So mutual fund offers a great avenue for those people who have very little knowledge about stock market, and for those people who uh, don't want to do things on their own. For them, mutual fund plays can offer a very good option to invest. Now let's also need to understand that, let's say you people decide to invest in a mutual fund, and each one of you invest thousand rupees. So once you invest thousand rupees, what will happen to your thousand rupees in the background? How that thousand rupees gets invested, and how that thousand rupees uh, you will be able to recover, and how that thousand rupees will be used by the fund manager to generate returns. So what happens in the background? Because it's more of a theoretical framework. What I've given you is more of a theoretical framework, but from a practical standpoint of view, the moment you invest in a mutual fund scheme, how does it works in the background? So that is something which we need to discuss now. How mutual fund works in the background practically, right? So before we could understand the practical working of a new mutual fund, which I'll show it to you by using a numerical calculation. Before that, you need to understand certain terminologies. These terminologies will help you to understand mutual fund better. So you will understand these terminologies probably after the break. So you can take a small break and come back, and we'll continue with these terminologies and see practical working of a mutual fund. How you will get to know where your money is getting invested, and how you will get to know whether your mutual fund is making money or not. So that you need to. So before we could understand the background as to how a mutual fund works, let us get familiarized with some of the terms used in the mutual funds. A company issues a prospectus which has all the information about its performance, its past, its future prospects, its management team, its financials. Similar prospects is also prepared by a mutual fund organization. So this prospects is also called as offer document, something which you, I'm sure, are familiar with, because most of the time whenever there is a mutual fund ad, the ad disclaimer at the end always says that you should refer the offer document before investing. So when you are referring offer document, these terms are quite handy. These are terms which you need to understand. So let's understand these terms one by one. The first commonly used term in the investment setup, in the investment arena, in the mutual fund setup is the asset allocation. Now, asset allocation means diversifying the money into various avenues of investment. So where are you, in simple words, asset allocation means where are you investing? Which asset are you buying? It answers these two questions. Now, assets is something that helps you to generate money, right? So a share is an asset, a bond is an asset, a real estate property is an asset, gold is an asset, cryptocurrency is a digital asset, right? So all these are assets. So asset allocation means where the money is getting invested, because in mutual funds, as I shared with you, that the money you don't invest, the money is handed over to a fund manager from the by the mutual fund company, and fund manager allocates your money in various assets class. So what are those various asset classes where your money gets invested? It depends on the mutual fund scheme, and that is already described in the offer document. So if you want to know where your money is getting investment, you have to read the offer document. Anyways, nobody reads it because generally when we buy mutual funds, we either buy online or offline, in which if it is online, we can go through all the details given here on the website or on the application, mobile application. If it is offline, the executive will explain you all those details, right? But you should be familiar with some basic terms which would help you to select the right mutual fund. Now, fund manager. So who's a fund manager in the context of mutual fund? Is an individual professionally qualified. Uh, there are qualifications prescribed by SEBI for fund managers role, so that needs to be adhered to. So fund manager is basically an individual who is responsible for investing your money in various asset classes, and he has to ensure that the objective of the fund is met, for which he puts in a lot of effort. He uses his expertise and ensures that he puts in your money in the right avenues of investment so that it can generate returns for the investors. So this is a fund manager. Then you also have fund offer document, something which I did mention it to you. So Generally, it is said as offer document, and it contains comprehensive information about the mutual fund scheme. So all the details are mentioned here. Something which you have to read about is the objectives and the risk factors to get an understanding of the mutual fund and also to decide whether to invest or not. This offer document plays an important role in decision making process. Dividend. Now, dividend in the context of mutual fund refers to profits given to the interest in investors from time to time. So certain investors want to withdraw the return what is being generated. Certain investors don't prefer to withdraw the money, but they also want the return generated also to be reinvested. So if the company is giving you the return generated from your investment, then it is called dividend option. Now, dividend and growth are two different components. So you need to choose which one suits your requirement. In dividend, as I mentioned, the profit generated from mutual fund gets uh, distributed to the unit holders. Mutual fund holders are also called as unit holders. But in growth funds, you don't want to opt for the profit, but you want the profit also gets reinvested. Now, what it means is, let's say I invested 100 rupees in a mutual fund, and in 1 year I have earned 10 rupees. So in case if you want to withdraw that 10 rupees, that is called dividend. But if you want that 10 rupees, whatever you have earned on your 100 rupees also to get reinvested, that is called growth. So you have both the options to go for. Now, generally, all those people who are retired, who want some sort of a regular income, they opt for the dividend model. And a lot of people also opt for the growth model because in growth model, you get to make more money because you're not only earning money on your principal investment, you're also earning money on the interest which your investment has generated. So there's a dual benefit when it comes to growth option. Now you also have an entry load, also known as the front end load, which as per the SEBI guidelines cannot exceed more than 2.25% of the amount what you're investing. So this is the amount the mutual funds end up paying when they join mutual fund scheme. It's like a premium. If there's too much of demand for a mutual fund, certain mutual funds, especially fund managers who have a very good reputation of generating good returns for the investors, who have a good track record, such fund managers, whenever they undertake any fund and when a mutual fund company appoints such reputed fund managers, obviously the demand would be very good for those mutual funds. Everybody wants to buy. So unlike shares wherein there are limited quantity, in mutual fund it's not the case. You can invest, right, as many as investors can invest. But mutual fund companies want to capitalize on that demand factor for which they ask you to pay a premium price. Right. So let's say if 100 rupees is the unit price of the mutual fund and if 2% is the front end load, that means you end up paying 102 rupees. So 2 rupees is the entry load what you have paid, or it's kind of a premium what you have paid for the good demand. So that is called entry load. Likewise, we also have exit load. Now, entry load makes sense because mutual fund companies can end up making good money because of the great demand for a specific mutual fund scheme. But what is this exit load or the back end load? Now, it is a fee charged if the investor wants to exit the mutual fund scheme. And this is a percentage of the overall worth of the investment amount. Now, why invest mutual fund companies charging you when you're leaving the mutual fund? This is to discourage people from leaving the scheme. Usually, most of the mutual fund companies don't charge this, but they have the rights to do so. But most of the mutual fund companies don't charge any exit load fee when you want to quit the mutual fund scheme and withdraw your money. So this is the front end load and back end load, which is commonly prevalent in the mutual fund. Now, sale price or the offer price is the price you pay to invest in a scheme and may include a sale load. So that is also a kind of a fee, right? So the sale price is the price at which you end up buying a mutual fund unit. Now, redemption price, this is the price what you get at the time of selling the mutual fund. So both these prices will determine whether you have made profit or loss. So sale price is the buy price, whereas redemption price is the sell price, right? At which investor sells back the unit of the mutual funds. Then you also have switching. This is a very interesting option offered by mutual fund company because generally, when you end up investing in an avenue which is not making any profit, you have the option of leaving, going for an exit. But switch facility offers you to switch between one asset class to another asset class. Let's say you invested in stock market, but unfortunately for some reason, stock markets are not giving you favorable returns. Stock markets are underperforming. In a situation like this, you have an option to switch the asset class. So you can tell your fund manager you don't want to continue to invest in stock market and let your money be now reroute out to a different asset class. Let's say from stock market you want to shift to gold or bonds. So that option is available and that option is called switch facility. Right. So switch facility is not just given just like that. You have to pay a small fee for that also. And of course, there is a tax implication also, which you need to do an assessment of whether it is impacting your decision in terms of tax, because at times mutual fund companies, when they switch, you might end up paying tax, right? In case if you have made any profit from your previous investment. In case if you have not made any profit from your previous investment and you want to switch, of course, there's no any charge as such, right? So that is your switch facility. Then you have corpus. Corpus is the amount of fund collected from the investors. So the amount pooled up from all the investors is called corpus, and this money is what the fund manager invests in the financial markets. New fund offer, which means this is a new fund, this is a new mutual fund scheme. So this mutual fund scheme is not prevalent in the market at the moment. It is relatively a new scheme which is being offered by the mutual fund company, because you have the option of both. You can invest in existing schemes also. You can invest in new schemes also, just like your financial equities market, which I was explaining you in the early sessions. So I told you if you want to invest in stock market, uh, you have the option of either doing it on your own, right? I mean, you can invest directly. You can invest in primary market or secondary market. Primary market means you have to buy shares in the IPO process. Whereas secondary market, the same shares gets listed and then people keep buying and selling it. That is called secondary or the stock market. So likewise in mutual funds also you have that option. You can directly buy the mutual fund in an NFO. That means that's the first time the new scheme has opened up. Or you can also buy from an existing scheme which is already prevalent. So both the options are possible. So NFO means it's a relatively a new scheme which has come into the market. So if you don't like new schemes, then probably you can invest in the existing schemes. The choice is yours. Either invest in a mutual fund, either in a completely new scheme or in an existing scheme which is already available in the market. So NFO stands for new fund offering. This is like an IPO of mutual fund. Now let's understand the working of the mutual funds. We'll take some numerical calculations to do this. This will give you a better picture. So let's assume a very small mutual fund that has initial investment of 1,000 units and each unit is worth 10. Hence, the total amount of the fund is 10,000 and this is what referred to as corpus. So let's say we are a mutual fund company, right? Let's say I'm that mutual fund company who is issuing only 1,000 units of mutual fund. And once this 1,000 units gets exhausted, the trading will happen only between the members. So as a mutual fund company, I'm issuing only 1,000 units of mutual fund, and each unit of mutual fund is worth 10 rupees. It's like I'm issuing 1,000 shares and each value of share is 10 rupees. But we don't use the word share in mutual funds, we use the word units. So which means the corpus, that means the kind of money which is being pulled up from the investors would be 10,000 rupees. 1,000 units into 10 per unit, 10,000 rupees. So let's say later I expand and say I'm okay, since the demand is too good, I'm issuing another 200 units. So 200 units into 10, again 2,000 rupees. So overall corpus now is 12,000 rupees. So 12,000 rupees is now collected from the public by selling 1,200 units of mutual fund at rupees 10 each. Now this 12,000 rupees mutual fund company, I will hand it over to the fund manager. Now a fund manager, depending on the objective of the fund, should decide where the asset allocation should be done. Now this, let's assume this is a mutual fund which is a kind of a hybrid fund, because it does not only invest in equity, it invests in different portfolios. So this is a diverse mutual fund, diversified mutual fund. Various asset classes the money gets invested, and by and large the asset classes are risky asset classes. So let's say what I've done is, with the 12,000 rupees what I've collected from 1,200 people, depending on assuming that I've only one person has bought only one unit, right? So how many people I am selling this depends. If one person only buys all the 12,000, 1,200 units, then of course there'll be only one unit holder, right? So it depends how many people buy. But our assumption is that each individual has bought only one unit. So we have sold this to 1,200 people. So 1,200 units of mutual fund into 10 rupees, 12,000 rupees is the corpus or the fund collected. Now the fund is with me, I'm the fund manager. Now I get to decide, depending on the objective of the mutual fund scheme, where do I invest? It's not like that after collecting mutual fund money, the investors have no option and the complete rights are given to the fund manager where he wants to invest. That is not how it works. Investors are informed in advance. In the prospectus also it is mentioned as to where your money gets invested. So you can't give investors surprises, but rather you should keep the investors informed as to where their money is invested. And this is informed in the prospectus, so investors have the clear idea as to where their money is getting channelized. So in my case, what do I do here is that how do I spend this 12,000 rupees is I've identified three asset classes. One is shares, the second one is gold, and the third asset class is bonds. So 5 shares of Infosys at rupees 1,000 per share. I have spent already 5,000 rupees. Gold, I've bought 1 gram gold at rupees 5,000 rupees. 10,000 rupees is gone. And 2,000 worth of bonds I have purchased. And these bonds are issued by NABARD, National Agriculture and Rural National Agriculture Bank for Rural Development, and the bond value is 500 rupees. So 500 rupees into 4 bonds, 2,000 rupees, and these bonds give interest at 4% per annum. So the money is already invested now. Game over, right? 5,000, 12,000 rupees is gone. Now you have to wait and see how these asset classes perform and what is the return these asset classes offer. So let's say in 1 month time, what has happened is Infosys share price has gone up from 1,000 rupees per share to 1,500 rupees per share. So which means each share has generated a return of 500 rupees, which is quite good. So 500 into, 1,500 into 5 shares. The value of 5,000 now has become 7,500. On top of that, the company has also declared dividend of rupees 10 per share. So since we bought only 5 shares, so 5 into 10 rupees, 50 rupees. So the worth of our investment and the value of Infosys shares as an asset class is now 7,550 rupees. Now what has happened in case of gold? Gold has also performed well, and there's an increase of 800 per gram, which means 5,000 rupees worth is now 5,008 rupees. So in this way, gold has also performed decently. Now coming to interest. Right now, there are various ways of doing it. You can either calculate interest for 1 month also if you want and show what is the profit you have made. I've not done that, but rather I've assumed that the market price of the bond has also gone up. Now, just as share prices go up, market value of the bond can also go up, provided the market rate of interest falls. If the market rate of interest falls, there is an increase in the value of the bond. If the market rate of interest is more than the rate of interest offered by the bond, then the value of bond will fall in the market. So here we have assumed that the market rate of the bond has the interest rates has fallen down, and therefore the value of bond has increased from 500 rupees to 510 rupees, which means on the value of each bond you have made a profit of 10 rupees. 4 bonds 40 rupees. And for 1 month interest, if you want, you can add that also. I have not done so, but it is good that we add 1 month interest also in that. Now, what is the value of my investment? What is the value of the mutual fund? When we invested, the mutual fund was worth only 12,000. Now the market value of all the asset classes, the value of the mutual fund is 13,390 rupees. So from 12,000, the value in 1 month has gone to 13,390 rupees. Now this 13,390 rupees is the net asset value, NAV. NAV is the worth of the mutual fund investment calculated on a regular basis. Usually it is calculated on a daily basis. Every day the value of the mutual fund, its worth is computed. So the market value of assets, that is 13,390, is the net asset value of the mutual fund. From this you have to deduct all the expenses. How much money should be paid to the fund manager as interest and his commission, that you deduct. How much tax you have to pay, that you deduct. Right? So all your expenses needs to be deducted from this. And after deducting all these expenses, that is what is called as NAV. Now this net asset value or the worth of the mutual fund will now be distributed to the unit fund holders. So how do we do this? 13,390 divided by 1,200 units is what was issued. So therefore, each unit is worth 11.15. When you invested, each unit was worth 10 rupees. Now each unit is worth 11.15, which means a rate of return of 11.5%. How did we calculate this rate of return? The rate of return calculation procedure is simple. So all you have to do is figure out the value, end value 13,390 minus opening value, divided by opening value into 100 will give you this 11.5%. That is the return of, that is the return each unit of mutual fund has offered. So this is how you calculate the NAV, net asset value. Now this is the basic calculation, which is very important for you to understand the concept of mutual fund. So whether your mutual fund is performing or whether it is underperforming, you have to look at the net asset value. Net asset value will give you a complete picture on the performance of your mutual fund. Net asset value is published on a daily basis. So you can figure out compared to yesterday whether your mutual fund has performed well or not. So that is the benchmark or the criteria for evaluating performance.